The US Federal Reserve, as expected, has held interest rates steady, but is indicating it is not done with rate hikes. The dot plot, which is the chart indicating how FOMC members see rates progressing from here on, shows that a majority of 9 members expect 2 more hikes, and that's the shocker. Also important is that the FOMC now sees US GDP in the fourth quarter at 1%. This is up from just 0.4%, which was the earlier forecast. Likewise, unemployment is now forecast down at 4.1 by the fourth quarter versus the earlier forecast of 4.5%. So basically, they see a much stronger economy this year. To discuss the key takeaways of both the summary of economic expectations and the rate action in the dot chart, I have with me Robert Sockin, the global economist from Citi, and Aditya, Bhave, senior economist from Bank of America. Gentlemen, I'm deeply grateful that you have stayed up so late for us here in India. Robert, let me start with you. This rate hike, 2 more, is it changing entirely your expectations as well?
Well, thank you very much for having me. And actually, we have had the terminal rate for the Fed at 5.25 to 5.75 for many months now, and have actually held that terminal rate view even through all the banking stresses that we saw over the last several months. So the fact that the Fed, through their dot plot, is now guiding to that type of terminal rate is very much where we expected them to eventually land. And our view there is really based on that services inflation that continues to be very, very sticky on the non-shelter services side, has shown very little progress over the last several quarters. What was surprising to us today was, the way in which the Fed had signaled that they wanted to do more hiking. To us, we thought that they were going to hike today and then potentially do 1 more after that. Instead, they decided to pause, wait to see a bit more data, but signaled still that they were going to do 2 more hikes. So they very much kind of ended up in the same hawkish place that we thought they would. But we still find the desire to pause here, but signal 2 more hikes to be a little bit odd. I think the best way to square that is the Fed thinks in the base case, most likely they'll have to do more, but this kind of buys them some time and allows them to see a bit more data before making that decision. So on net, not too surprised, although this was a bit of a confusing and surprising way to do it.
Okay. Well, Aditya, your thoughts. The Fed Watch tool, the CME Fed Watch tool, is still indicating only a 60% chance of 1 more hike in July. The markets are not pricing in that second hike at all. Where do you stand? Have you changed your mind?
Right. So what I thought was interesting was that although the summary of economic projections, as you said, indicated that the Fed is a lot more confident about the trajectory of the economy than it was in March, with higher growth, lower unemployment, stickier inflation, and all of that warranting 2 more rate hikes, Powell didn't actually validate a July hike. He said the July meeting is live. And at the end of the day, we think the bar for the data to meet the criteria for a July hike will be relatively low, and the data will meet those criteria. So ultimately, we do expect the Fed to hike in July. And then once again in September or November, Powell had a chance to validate the July hike a little more strongly, and he didn't, which is why markets have not fully priced in even 1 more hike, never mind 2.
Okay, so you're sticking with this 5 to 5.25 as the terminal rate?
No, we expect 2 more hikes. We expect them to hike once in July and once in September or potentially November. But my point is that the markets didn't price that in today, despite the dot plot. And that was because the Fed didn't quite validate that July hike the way in which they could have.
Fair enough. Jerome Powell continued to say that they have still not made up their mind about July, and he added that he expects July to be a live meeting. I think that's when the markets actually recovered, when he said, that they will take all data into consideration. The markets recovered when he said that. Robert, what about the quality of economic growth or the pace? Is it going to be that strong? I mean, they have upgraded it by a full 60 basis points.
Yeah, and it's a great question. And we thought going into this meeting that they would have to upgrade those forecasts, in part based on just a much stronger first half of the year than they would have expected in the previous SEP. But on top of that, I think an important theme for the US economy is that growth is proving a lot more resilient than expected. You're seeing that in the labor market numbers. The Fed also significantly lowered its forecast for the unemployment rate for the year. And that's really being powered by stronger consumer spending than expected and resilience in services sectors. And actually, for us, we've been particularly surprised by that ongoing strength. And a few months ago, we shifted out our view of when the U.S. economy is likely to go into recession from Q3 of this year to Q4 of this year. And that's really based on the resilience that we've seen in the labor market and overall economy over the last several months. And, given the continued strength that we're seeing, I think there's even a debate if Q4 is too early to expect a recession. Now, we do think eventually some type of technical recession is needed to soften the labor market, to soften the feed through into services, wages and services prices that's driving a lot of the services inflation we're seeing. But where we are right now, it's hard to see the U.S. economy going into any type of sharp slowdown until at least the end of this year.
Okay. Well, going by the Fed, not even by the end of this year, perhaps only next year, going by the summary of economic projections. Again, the growth question to you, Aditya. Every central banker is giving us the same message. The SEP is telling us that the economy is much stronger than we thought. And the Bank of Canada said much the same. They were not pinning their rate hike, their surprise rate hike decision on inflation as much as on growth, which they saw as stronger. So do you think that's something markets should take note of? Growth is really pretty strong.
Yeah, I think the US economy has held up very well. We actually have also revised our forecast just as of today. We moved the recession out from the second half of this year to the first half of next year. There are several factors going into that. One of them is the strength of the labor market, as Robert mentioned. And I would note there that labor supply has improved a lot more than we were expecting. And that's really helpful because it helps keep downward pressure on wage inflation as the labor market continues to expand. Beyond that, there have been some very helpful upward revisions to the data, which suggests that the first quarter will come in closer to 2% rather than 1%. So that gets you halfway there in terms of your 1% annual growth. And so the labor market has been strong. There have been upward revisions to the data, and some of the risks have also receded. So if you think about the debt ceiling, that got resolved. So far, banking stress has remained contained. So all of this suggests that the U.S. economy is holding up pretty well for now.
Okay. Well, actually, that makes the global economy for us, because we are hearing this from a couple of central bankers. Yes, there are recessions reported technically in New Zealand and earlier in Germany, but there are a lot of central bankers saying growth is good. Now, Robert, therefore, I wanted to ask you about the state of the economy next year. If we are going with this 5.6 as the likely midpoint of the rates, by next year, will it be a very hard landing in 24? Good now, but serious in 24?
That's another great question. Also, just to your point before, I think that we've seen globally growth be much more resilient than expected, not just in the US, but many other economies around the world, due to this resilience in services sectors that we were discussing earlier. And that's led a lot of upside surprises in growth in developed markets and emerging markets. And a lot of these views of when recessions might happen being shifted out even further in the calendar. For us, as I noted, we do think that you need some type of sizable softening in the labor market and the economy more broadly to bring down some of these services pressures that we're seeing on the inflation side. So we do think you're going, as I said, to get that slowdown the end of the year into the beginning of next year, but we're still not in the camp that that's going to be any type of hard landing into 2024. The recession we have is relatively mild by historical standards in the US. and more generally globally for all the recessions in our forecast. We have the recession in the U.S. lasting only 2 quarters. The average recession lasts closer to a year historically in the U.S. And we have the unemployment rate rising less than is typical and the GDP falling less than is typical. And that's really due to the strength that we see on private sector balance sheets, on the corporate side, and on the consumer side. And we do think that once the economy slows down and inflation falls more materially, the Fed's going to start easing policy rates pretty significantly starting at the beginning next year. So even though we do think a recession is likely, we're not in a hard landing camp. We still think it's going to be a fairly mild downturn.
What about you, Aditya? I can't remember when the interest rates, even during the Lehman, the global financial crisis, the peak didn't go to 5.6. So can that really shock the economy in 24, though 23 can be all Diwali?
Right. So 23 does look a bit like all Diwali, doesn't it? Yes, the peak in the global, just before the global financial crisis, was 5.25%. So the last time you got to 5.6, if the Fed indeed gets there this time, would have been in the late 90s or in 2000. So we have a similar view on growth. We really think that the recession next year will be quite soft. In fact, it'll be within range of what you would just call a technical recession or essentially a soft landing. And that's just, our respect for the data that we're seeing that have been very resilient. The consumers held up very well. The labor market has held up very well. And the housing market is starting to find a bottom. So in the second half of last year, residential investment contracted about 26% annualized. If you go from 26% to something like even 0% growth, then that's much less of a headwind, and it gives you much more wiggle room in the other sectors of the economy in terms of avoiding a recession.
Okay. Well, I'm going to ask you both an unfair question. You're not economists, but this is a market question. But you're free to take a jab at it. Aditya, would you say, therefore, that it looks like equity positive and a bond negative kind of, next few months that we see? Growth good, but rates are going to rise.
Well, front-end rates would mechanically rise if the Fed hiked. I mean, there's probably less upside for back-end rates because the markets might think that the Fed will cut more or inflation expectations won't increase necessarily as much if the Fed is relatively hawkish. So there's a few reasons why back-end rates will probably be less responsive than front-end rates to these extra 50 basis points of rate hikes. In terms of equity markets, a little bit outside our purview, our equity strategists have a year-end forecast around 4,300.
Okay.
So they're not too bearish. Okay. We have digested the first 500 basis points of hikes a lot better than I think most people would have expected.
Okay.
So it's not clear that the next 50 will be the breaking point, but they could be.
Okay. What about you, Robert? Again, do you think for the moment it's looking good for equities?
Yeah, that's a great point, question. I agree with everything that's been said so far. In our view, if let's say the Fed was done today and wasn't hiking any further, and inflation were to fall notably next few months, you could get another substantial leg up in equities to something like 4,500 or even higher. I think in the environment that we're in, if we are correct that you get a little more on the rate side and you go into some type of technical recession, so not a major downturn, but some type of material slowdown, you're probably not more likely to move somewhere kind of sideways from here or maybe a little bit down. So I wouldn't say we're particularly bullish on equities through year end. But that being said, I don't think you're likely to fall very far from here, even if we go into the recession that we noted later in the year.
Fair point. Thank you very much, Robert Sockin and Aditya Bhave, for staying up for us and helping us parse the FOMC policy. So that's it. Both our economists are expecting 2 more rate hikes, like the FOMC majority members. Let's see. It's actually a very strong growth that all central bankers are forecasting. Well, that's good for equities for now, but let's see how things pan out later on. That's it on this edition of It's the Economy. Chartbusters up next.